Good morning and welcome to this Wednesday, September 16th, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, I do have to say it's a great day for me and my family. Did have the birth of my first grandchild yesterday. So excited. Everyone in the family is doing great. It is having a short-term impact on some of the work that I've been doing here at Earnings Beat, so you have to have a little patience and bear with me, but the daily market report probably will be very abbreviated again today as it was yesterday. Just got some things, obviously, I want to be able to do and take care of today, so I wanted to let our members know that. Let's go ahead and jump in first. For those of you who maybe are new to Earnings Beats, I want to just let you know that you do have an option for a free newsletter. You can go to our website at earningsbeats.com. You can sign up for our free Earnings Beats Digest newsletter. All it requires is a name, email address, hit that subscribe button, and you'll begin to get our newsletter, which is published 3 times a week, Mondays, Wednesdays, and Fridays. Some really good information. I was just looking recently, some real nice trade opportunities have been featured recently. Also, back at the beginning of the month, I did a analysis of the S&P 500, provided a downside target, which we almost got very close to it. So there's some really good information in there, but for the most part, it's just very educational. We're trying to help give back to the community and provide some good information. And if you like what you see there, then of course you can come over and join our paid service where we give a lot more information, a lot of educational materials, some great tools, especially if you're a stockcharts.com member as well. A number of great chart lists. Of course, you can follow along with our portfolios. Model portfolio, by the way, starting to pull away from the S&P 500 again, now up more than 3 percentage points above the S&P this quarter. If we can outperform the S&P this quarter, it'll be the 7th time in the last 8 quarters that we've done that. And for a lot of mutual fund companies and portfolio managers who struggle to beat the S&P 500 on an annual basis, it's pretty impressive when you can beat it 7 out of 8 quarters. And right now we're at least on our way to trying to do that. We certainly aren't perfect. You can see our aggressive portfolio this quarter has struggled. We had 2 or 3 stocks in there that had some bad news. I think it's trying to recover a little bit. We'll see how it does the rest of the quarter. Income portfolio getting a lift today. FedEx reported yesterday. That should maybe close the gap there on the S&P, and the strong AD portfolio also outperforming the S&P 500. So all in all, it's a decent quarter, especially considering the consolidation and here in September, the trepidation that traders have with regard to the growth stocks. We've been struggling a little bit with that, trying to rebound. We'll talk about that a little bit more in the show. Anyhow, if you are new, go to our homepage, check out these various services. I think you'll enjoy what we have to offer. Okay, let's talk a little bit about what happened in the market on Tuesday. I'll be honest, I didn't really watch it very closely yesterday for obvious reasons. But we do see the Dow flat, S&P up 0.5%. NASDAQ was up more than 1%. So we did see a little bit of rotation back in toward those growth stocks, which was nice. A lot more work to do, though, and I don't know. I still think maybe we have one more leg to the downside. I'm hoping I'm wrong. Well, in a way, I'm hoping I'm wrong. If I'm right about the long term, short term pulling back would actually probably be a better thing, just to provide a better base for the next advance, which I think is coming in the fourth quarter. Mid caps flat, small caps flat. Leadership, though, you can see returned a little bit to some of the key areas. We saw communication services yesterday perform well. Technology performed well. Consumer discretionary. 3 of the key areas were on the top or near the top of the leaderboard. Real estate also up there trying to make a breakout. And keep in mind, a bull market, one of the hallmarks is wide participation. We want to see real estate breakout. We want to see financials breakout, certainly financials and industrials. We want those groups performing very well, even all the defensive groups, not just real estate, but consumer staples, utilities, the healthcare area. Pharma's one of the more defensive area of healthcare trying to make a breakout. I'll talk about that group in a little bit. But the more groups that break out, the more bullish charts that are out there, technical traders are going to buy. They're not going to sell. You're not going to see technical traders selling into bullish chart patterns and breakouts. You'll see some, but I'm just saying the overwhelming majority will be buyers, and that's what's going to continue to keep the bears at bay. The more and more charts that turn bullish, and we're seeing many of the pandemic stocks that struggled for months, now there are a number of them coming up near those June highs, some of them starting to break above those June highs. You got, some much better looking charts out there like Starbucks, that struggled for a while. Now they're coming back. More and more of these charts that look good, it's going to help us in the fourth quarter. And the groups that have been strong, software, semis, computer hardware, Apple, all these companies that have pulled back recently, they still remain strong technically. So the ones that are pulling back are still strong. The ones that are seeing the rotation are becoming strong. And I think in the fourth quarter, we're going to see another big move to the upside in the market. I could be wrong, but that's just what I'm seeing based on the way I look at the market. All right, 10-year Treasury yield. First, economic reports. Oh, and I did forget to go get the August retail sales. That came out just a little bit ago. I didn't go back and look at it. I know the expectation was for 1%. In fact, I'm going to go ahead and just bear with me a second. I want to see how that came in this morning. But, I mean, we've been seeing some pretty good economic reports out of retail sales. Last month was pretty strong. Of course, recently we've had some record moves to the upside, but that came out of the pandemic. That was, we had some horrible retail sales reports back March, April, May. And so now it's kind of turned the corner as we've been reopening the economy. So, you almost have to net all of it together, in my opinion. All right, retail sales out this morning. And for August, they rose 0.6%. Market was expecting 1%, so a little less than expected. If we strip out the autos, it rose 0.7% versus the expected 1%. So retail sales were good, but came in lighter than expected. So all in all, probably not a great number. We will be getting the Fed later today. They've got a 2-day meeting that wraps up today. So at 2 o'clock, we'll get their latest policy statement. I don't expect anything that's going to hurt the market. I certainly don't expect a change in interest rates. So I don't think that anything there will happen. But of course, the market's going to pick apart every word that Jay Powell has to say. And so that maybe provides a little bit of, might provide some anxious moments this afternoon. But I can't imagine that Fed Chair Powell is going to say anything other than accommodative things, things that are going to continue their accommodative stance. So, with the market, especially with the market pulling back here and struggling a little bit here in September, if anything, I suspect that, they'll talk about keeping rates low for a while. They've talked recently about inflation and how they're okay now to let the inflation go above that 2% target level for a while. So there's really no reason for anyone to be thinking that the Fed's going to be raising rates anytime soon. All right, so what else do we have? The July business inventories come out a little bit later this morning. June, we saw minus 1.1%. July, of course, this is a little bit in our rearview mirror. We're still looking back at July in terms of business inventories, but we're expected to see a 0.1% rise. September housing market index, this will be a pretty big one. 78 is the estimate. August was 78, and that tied the all-time high, not just the high since the pandemic. The all-time high was 78 in August, and now in September, they're forecasting 78. But the consensus estimate is anywhere from 75 to 81. So we've been seeing a lot of better than expected news out of housing. We could get the all-time high on the housing market index later this morning. In the news, I want to just mention a couple of things. Yesterday, JP Morgan lowered their fiscal year 20 net interest income guidance. And with rates low, does not surprise me. Anytime we've got low rates, banks on a relative basis are going to struggle. And I'm going to pull this up on a relative chart so that you can see. Volume picked up yesterday. JP Morgan sold off, but we still held the prior lows. When we look across, first of all, you got the bank index, which is just not doing much of anything. JP Morgan relative to the bank index trying to make a breakout, but bank index has been so poor. I mean, it's nice to have a leader, but look at the relative strength of the S&P 500. Pretty much anything in banking is struggling right now to keep up with the S&P. Why? Well, look at the bank index relative to the S&P. Continues to go lower. So don't confuse this little bit of absolute strength with relative strength. Relative strength, we're down near a 52-week low. Banks continue to struggle, and until we get a definitive breakout on that 10-year treasury yield and really start to trend a little bit higher, we don't need to go up a lot, but we need to break out at least above 0.75% before I'd even consider any of the banks. Longer term, I don't have a problem. I'm talking about short-term trading. So from a short-term trading standpoint, you can see JP Morgan not really doing well. But there are banks out there even worse. Let's talk about Citigroup. Now, Citigroup is facing some possible penalties from regulators. And the only thing I can tell you is that the market is saying they're not possible they're going to get them because things are really being discounted hard on Citigroup. Look at the volume in the last 2 days on Citigroup. That is mass distribution. And if you can't see it with the volume and those big red filled candles, look at the AD line. I mean, it is a sharp drop to the downside. A lot of folks bailing on Citigroup right now. You can see it there. You can also see it down here in the relative strength lines, not only versus the banks, but also versus the S&P, dropping to a new 52-week low. Citigroup not doing well. And you want to stay away. When the charts are telling you this, stay away. Another company, TRTN, actually raised their Q3 earnings per share guidance. And I was looking at the chart. Look at the relative strength been building now for the last couple of months. So this was telling us that things maybe were starting to improve. The stock was at about a 7-month relative high to the S&P 500 when it came out with the news. See how the technicals precede? We always talk about technicals precede fundamentals. This is a perfect example. Prices are starting to go up. Relative strength is building. Then they come out and they raise their guidance. So if you're sitting back and you're trying to invest strictly based on fundamental news, you're behind the 8 ball. And this is coming from somebody who practiced public accounting for 20 years. I love the fundamental information. Don't get me wrong. I think it's really important to the long term. But short term, whether you buy or whether you sell, to me, comes down to the technicals, not the fundamentals. By the time you see the fundamentals, we've already made the big move. Look at this move. The stock was at $30 beginning of August. Now it's up 37 and change. That's more than a 20% move in 45 days, and now the news comes out. If anything, well, maybe we gap up, maybe we pull back and hit the 20-day. It might be a buy on rumor, sell on news kind of situation. We'll see. All right, let's move on. Talking technically, I wanted to give you a few nuggets of information. First thing I want to do is just go through, and I look at the IWF, IWD all the time. This is growth versus value. This has been huge throughout the pandemic. Growth stocks have done very well. Value stocks have not. And we go through periods where growth just soars, and that's when you want to be in growth. And then you go through pullbacks, and that's what we're in right now, where value stocks are doing a little bit better. It's not that, I mean, some value stocks are doing really well, but mostly it's just that the growth stocks are selling off. We've seen a lot of the technology and consumer discretionary stocks that had been leading the market to the upside selling off, and that's what's driving this ratio lower. So there's good news and bad news here on this chart. The good news is the uptrend remains intact. I see nothing wrong with the fact that we pulled back. I mean, when you have these big moves to the upside, and we just went through this one in August, last 3 weeks of August into early September. When you have these big moves to the upside, that's a lot of money pouring into the growth stocks. You're going to see profit taking from time to time. It would be wonderful if we just went up every day, but we don't. We don't go up every day. And so we go through periods where we consolidate, and I think we're in one of those periods. So the good news is we're still in the uptrend. Everything looks great. The bad news is that many of these pullbacks are ABC corrections. Just about every time you look, here was a big move up, A, B, C. 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 Move up. All right, just one move, but this one never actually broke out. See this high? Never actually took out that. So this is all part of one move to me, to the upside. A. Is it just gonna, is that it? I mean, was this the little b and a little c? I don't know. It just seems to me as we go toward the end of September, maybe we're gonna get one more push to the upside that becomes our B. If it happens, I would think it's gonna happen this week. And then next week becomes a very bearish week for the market historically. September 21st to the 27th is the third worst week of the year historically for the market. So if we do bounce here, don't be shocked if we have one more pullback. I wish I could guarantee it so everybody could just sit in cash and wait for it. I can't guarantee it, but I wouldn't be surprised. I wouldn't, you know, if all of a sudden we see one more big move down next week, I wouldn't be rushing to the exits and saying the bull market's over. I'd be licking my chops and waiting for a better entry into stocks. I've been saying all along that if you're looking for entry in the stocks, you should be using this weakness to begin building positions. And I think many of those positions, in my opinion, this is just me. Everyone has to make their own call, has to determine their own risk. But for me, it's those growth stocks. I want to be building positions in those growth stocks. If I'm wrong and we're heading into a horrible fourth quarter, that's not going to pan out well. Growth stocks normally do not lead in bad periods. I just don't think we're in a bad period. I think we're going to have a good period, although we could set up one more move down, by the way. And if you notice, when we get these big moves up and then we pull back, move up, we pull back. When we pull back, we set a pretty important low. So when we moved up here, we pulled back with this ABC. Look at that prior high, relative high. Here's the relative low. That's a really important level. I would begin to get more nervous about the market. I get this question sometimes. You know, what would make you, especially whenever I'm with Dave Keller. Dave Keller always likes to ask me over at Stock Charts, you know, what would make you turn less bullish? What would really start to, you know, make you think that maybe your thesis is off, even if it's just, you know, short to intermediate term? For me, it would be losing some major support levels on a relative basis. That would be a big one for the IWF, IWD. I mean, do I think we would be into another horrible bear, secular bear? No. But would I be much more cautious with the growth stocks? Absolutely. If we were to lose that level, I would watch it. Also, we got a trend line in play. So we would be losing this longer term, or, well, depending on how you define long term, maybe intermediate term uptrend line, and then also this relative support line. If we lose both those levels, you have to be a little bit more objective. And I'm not saying, again, I'd have to look at everything else going on in the market and what's going on with the major indices and so forth. If the market's still going higher and now it's just the market is loving value stocks over growth stocks, then the bull market may still be in play. It's just that what the bull market represents and the areas that we might want to be thinking about may be changing. That would be the, you know, the rationale there. Now, if the overall market is selling off, everything's getting hit to the downside, then we got some other considerations. You know, we have to look back at those weekly charts and maybe start to look at a little bit deeper selling. But I'm getting way ahead of myself. First thing I would be doing is just making sure the trend line and this relative support level hold. So one more move to the downside, in my opinion, would not necessarily be a bad thing. And sometimes it's better to realize, at least for me, to kind of look to, okay, what could happen? I know it could go higher. I'm bullish. I know the market could go higher, but if it goes lower, what could happen? And at what point would I be needing to rethink my strategy? And that's where I come up with these levels. All right, 60-minute charts. Let's look at the spider. Notice we're bouncing off the rising 20-hour EMA. That's good, right? Short term, we've been trending higher. Futures were up this morning. Got to get through this gap resistance on the spider. Haven't done it yet. Maybe we've got a bottoming head and shoulder, a reverse head and shoulder, left shoulder, neckline, head, neckline. Maybe we're going to go down one more time. But at least this morning, I know that we had futures up. I think it was 341 and change on the spider last time I looked. So we doesn't look like we're going to open up above that gap resistance. So maybe we have one more move to the downside, put in a right shoulder. Maybe, as I said earlier, we have one more move to the downside, period. Maybe the market needs to break below that prior low. It is September, and this could be the time where we see one more move to the downside. We'll have to see. That would shake out a lot of folks that bought at the top. 358, if all of a sudden we're back in the 320s, get that 10% correction, 8%, 10%, whatever, that could spook a lot of folks in the market. In the meanwhile, we'll be watching to see whether key stocks continue to be accumulated. I'm going to watch those AD lines as prices move lower. So that's the spider. We can look at the QQQ. Same thing, holding the rising 20-hour, but we haven't even gotten up to the gap resistance yet. We haven't completely filled it. So you can see already on a relative basis, the QQQ not quite doing what we'd like to see. Spider's already been up to test this gap resistance. QQQ is not. So that just tells you over the last week or so that we've got a little bit of trepidation on the part of traders. They don't want that risk with the growth stocks, not yet. How about the IWM, small caps? Whoa, what's going on here? We already went through the gap resistance. Things are starting to look much better in this area. So is it time for small caps? Well, maybe be a little careful here. If we go out, actually, let's go to a daily chart. And let's get rid of the candlesticks. So if you're looking at a daily chart, what I would do is I would watch relative support, relative resistance. There's your relative support. See the low in July. So we went up. Small caps got a lot of love all the way through early June. You can see outperforming the S&P through June 8th. Here was your early July low. Look up here. We didn't quite get through. So there's your resistance up here. And we went down. We tested this. So yes, we're starting to look a little bit better when you look at that 5-day chart. But within the longer term picture, are you still as bullish as maybe you are if you're looking at the 5-day chart? I'm not. Now, if we hold this, we can turn around, go up and break out above that June high on a relative basis. That would be incredibly strong for small caps. I would love to see that. I want to see small caps do well. That's some of the more aggressive areas of the market. But I think with the pandemic, I think some of the small caps are being hit a lot worse than some of these large caps that have tons of cash and are mostly online. Some of these small company, brick and mortar companies having a lot of difficulty with the pandemic. All right, let's keep moving on. So we talked about a bull market and the fact we want wide participation. So what I'm going to do now is I'm going to go through some industry groups that maybe I haven't talked about as much because they haven't been leading throughout the pandemic, but they're starting to show more bullish signs. Look at restaurants, for instance. There was your double top, January and February, just above 2050. Look at where we are right now, 2057. You've been on this nice little move to the upside, got the accumulation distribution rising, and even restaurants, shockingly to me, as we kept going lower in March, look at the AD lines rising. And we've continued rising throughout, just set a new high here. However, notice on this last push to the upside, AD line hasn't started to go back up. So this one's kind of a question mark. I'd like to see the breakout, and I want to see that money coming back in and the AD line rising. So again, these are all companies or industry groups, I should say, that could help the market if we can get breakouts. We haven't seen the breakouts yet here, or we're kind of like right on the verge, maybe teasing the breakout. Publishing, high in February, up above 470. There's the double top, testing it, pulled back, had a little bit of selling on increasing volume. See the AD line going down. Right now, trying to get back through that 20-day, but this is another one to keep an eye on. Apparel retail. Look at these tops coming across here. Above 925 would be bullish. I like this. We went a little bit below the 20, starting to rise again. We're starting to show some better signs of trending in apparel retail. And so that's got me a little bit hopeful. Clearly a breakout above 925, that would be bullish. All right, how about the durable household products? Look at the tops back in January, February. We're right there again. Not able to make the breakout yet, but looking pretty strong. Once again, AD lines getting a little weaker here. All right, how about hotels? I don't talk about hotels very often, but a couple of things that, at least make me think we're going to maybe challenge for a breakout. There's the June high up at 1900. That we haven't had a close though. Well, we had one close here above 1800, and we're up challenging. We've been going through this 1800 level a few times now in the last few weeks, 2-3 weeks. So we're on the verge of trying to make a new closing high. I did like the AD line here back in August when on this move. You actually can see we had a higher AD even though prices were lower. But since we've been moving up here again recently, like some of these others, accumulation distribution pulling back a bit. Furnishings, making a breakout above that June high. So I said some areas are actually making that breakout above the June high, adding to the bullishness. And you can see the accumulation distribution, which on this move to the upside, you know, we were still putting in lower highs on the AD line, even though we were getting higher highs in price. That's changed. And now on these moves to the upside, we're starting to see the AD line rise. So it looks like maybe on furnishings, we're getting a little bit more accumulation. Gambling stocks. Here's that June high, 750. There's the double top. Look at us hovering above this 20-day moving average. Can we get that breakout 750? That'll be a big level. Mentioned the pharmas earlier. Pull up the pharma chart. See the highs back in January. Look at where we just reversed off of, 640. The AD line was setting a new high. Yes, we've pulled back. This could turn out to be a cup off of an uptrend. Don't know yet, but pharma's on a breakout above about 642, 643 would be bullish. Let's see, maybe just one or two more quickly here. Let's move into materials. How about the specialty chemicals? Look at these highs in here at 975. Got up to about 965, and now we're starting to rise again. AD line, though, is a little makes me a little nervous on this one. I mean, we shouldn't still be sitting back close to a 52-week low. So I don't know. Probably traders a little skeptical what's going on with the dollar. So they're not really committing here. On a relative basis, you can see at the end of August, we're actually at about a 4-month, 5-month relative low versus the S&P. So yes, a bull market is, rising tide lifts all boats. That's kind of what a bull market does. And so on an absolute basis, it's looking, making it look better, but it's got to make this breakout and it's got to start to show better strength in terms of AD and relative strength. We've gotten some nice relative strength here in September, but we haven't really seen that AD line turn up. All right, how about one more? And this is in the, this is in technology space, actually. Some of the areas of technology have not really performed as well, but electrical components and equipment index, you can see 400 is a big level. We got right up there in January, almost to 400 again, beginning of this month. And now we're starting to turn back up again. AD line in August actually moved to a multi-month high. Relative strength starting to build a little bit. This high was above this high and starting to turn up again. So we are seeing some more positives in some of these groups. And so that's one of the reasons that I'm bullish the overall market. I'm just seeing more and more groups trying to make the breakout. I think it's going to happen in October. Maybe it happens in September, but I think come October, we're going to see a lot more groups breaking out on an absolute basis. But let's really focus on the relative strength to see where the market is really, the areas that the market's truly interested in. All right, earnings reports, earnings spotlight, Adobe. Adobe came out with great numbers, beat the top line, beat the bottom line, 257 versus 240. Stock, last time I saw, was up a couple percent. So doesn't look like it's going to break out. I expect probably more sideways consolidation, but maybe off of earnings, we make another run up here for 535, 540. If you see a tail, if you're in this one and it gets up and it puts a tail intraday move above 540 and comes back down, closes below, say, 535, that might be an indication short term we're going to continue to consolidate. So keep that in mind from a trading perspective. FedEx, another huge report. I mean, this was a monster report. Revenues $19.32 billion. The market was looking for $17.46 billion. Earnings per share $4.87. The market looking for $2.59. I just said earlier this week, and of course FedEx in one of our portfolios, love the stock. I looked at FedEx and UPS and thought these were two of the best stocks coming into this quarter. And FedEx has proven to be much better so far than UPS. We'll see. UPS now is going to be reporting next. maybe we get that run up into UPS based on what FedEx just did. But you can see the volume was coming in. The relative strength has just been off the charts. This is what you want to see in a stock. Strong group, strong stock versus the group, strong stock versus the S&P, and strong group relative to the S&P. When you get those four going and you get a portfolio of those, that is how you outperform the S&P 500. And that's what we try to do with our portfolios. Brady Corp reported. And Brady Corp missed on revenues, missed on earnings per share. Look at the relative strength. Look at the stock. We just talked about, well, no, we didn't talk about electronic equipment. Talked about the other one, but you can see electronic equipment, this stock relative to its peers, 52-week low. Relative to the S&P 500, 52-week low. The group still trending lower over the last few months. You see the difference, but on an absolute basis, it still looks fine. Rising tide lifts all boats. Brady Corp comes out, misses top and bottom line. I didn't see their reaction. So let's pull this up. Actually, the market's open. I can give you just an update here. Gapped up even with bad results, but I'm not interested in this stock at all. Let's get a quick update on Adobe and FedEx. Adobe gapped up, not able to hold it so far, up 3 cents. FedEx, big move up 6% today. It's had a big move. Maybe it's a sell-off on the news. We'll see. But FedEx is strong. Any kind of a pullback. I love the 20-day as a possible entry if it does pull back. All right, 3 you must see. Let's wrap this up. INO, starting to see some more strength. This is a stock that's very volatile. Many of these biotechs, you've got to be careful if you're into individual stocks. I'll just throw that out there. Some of these companies maybe they got a lift earlier in the year because of the virus, something that they're doing relating to the virus. And they could be anywhere. This is a stock that went literally since February from $3 to $34, back to 8 and change, now back over 14. You've got to have a strong stomach. And you've got to be willing to lose some money. If you're not, a stock like this, you could easily lose 15, 20%. You also could make 100%. So it's really, is that the kind of trading you like to do where you're literally sitting at the casino? That's kind of what trading INO would be like. If you're not, then you should probably be looking at Starbucks or something like that, where you don't have to worry necessarily about a huge drop in the short term, but your gains aren't going to be crazy either. So different folks have different mindsets on trading. Some folks love stocks like INO when it starts to look better and starts to break up, printing higher highs and higher lows, and they want to ride the momentum. And if it goes down, it goes down. But this is their style. That's fine. But make sure you understand the risks of trading these individual small biotech names, because it can be crazy. I mean, you could wake up, INO could be looking good for 3 days, and the next day they come out with some kind of an announcement, something failed the FDA, and the stock's at 7. So if I trade these, one thing to keep in mind is trade fewer shares. You don't need to make, you don't need a grand slam. You don't need a 10-run homer in the bottom of the ninth. You got to start, with a few base hits first. And so I'd just be careful about getting too excited there. APPS, this is one of the technologies, a software company, been on fire. I actually think we could top here. Maybe we'll see how we finish today. Accumulation distribution is awesome. And I see this maybe as a cup. So huge uptrend. Be careful if, especially if you get a filled candle today. You opened at 29.50, which is above the prior closes over here. It looks like we got to break out. If we don't, then you probably got some market makers doing some manipulating in the short term. But very, very strong stock. I mean, this is one of the best software stocks out there right now. And then finally, SBAC. This is actually in the REIT, specialty REIT. And when you look down here and you see the specialty REITs not really doing well, they've done better in September. We're seeing more money rotating into the group in September. SBA Communications made a breakout. Not too many real estate stocks are making breakouts. SBAC broke out yesterday above this 320 level. Volume started to pick up a little bit, not exactly screaming at me, but we got a strong AD line. Overall, I think this one looks pretty good. If I'm going to be into real estate stocks, something like this would be more attractive to me than another stock that's underperforming. I want to have the leaders. And when you look at the stock relative to its specialty REITs, it's actually trading at about a 2-month relative high right now. Had a huge move earlier this year when it didn't, came back in April and actually went to a new high. Not too many REITs were doing that. So the stock does look pretty good to me on a relative basis. I'm just not really into real estate overall. I think that technology, consumer discretionary, communication services, even materials to some degree, I think those areas, maybe definitely industrials. Transports, by the way, I don't know if you saw yesterday when I was looking at the leadership among industry groups. When you look at the industrials, trucking was 1, railroads was 2, airlines was 3. Transport's definitely looking better. And I talked about that a little bit in I did a recording yesterday morning for the Your Daily 5 at Stock Charts. So if you go to YouTube and you search Stock Charts, Your Daily 5, you'll see yesterday I did a quick little blurb. It was like a 10-minute recording, but I talked a little bit about transports. They're looking really good on a relative basis. That's another thing that's got me very bullish about the fourth quarter. Why would transports be breaking out? They broke out last month. They're breaking out again on a relative basis to the S&P 500. You got to think about that for a minute. Why would they be breaking out relative to the S&P 500 unless the stock market is telling us that we are going to see economic improvement and strength ahead? That's why transports go up. Anyhow, let's go ahead and wrap it up with that. One quick look at the market. And we got the Dow up 66, NASDAQ 13, or Dow 66, S&P 13, NASDAQ 41. So on a relative basis, seeing maybe a little bit of strength in the S&P 500. Small caps, mid caps, a little bit better even. Still got some work to do here in September, I think. But overall, we remain in the bull market. I still am very, very bullish. But we've got to get through this period. It's almost like a bridge. Protect your account until we get, to the other side of this. And by protecting, we talked a couple of weeks ago about the market looking somewhat, I was somewhat cautious, just looking ahead, just looked like trouble might be brewing. Well, we're seeing that trouble now. Using this trouble to build positions for the fourth quarter makes a lot of sense to me. All right, I'm going to wrap it up again. For those of you that are Earnings Beats members, services might be just a little bit limited today. I got a lot on my plate personally with Aaron having delivered my first grandchild yesterday. So have some patience there. We'll be still keeping an eye. I'm not completely ignoring the market. I'll have my eye on everything, but I'm not really expecting anything huge today. And that's it. So everybody have a great day. I'll be back tomorrow to do the Trading Places show over at Stock Charts. Join me there. Everybody have a great day. Happy trading.